Welcome students. In today's episode on company account, we will be discussing about share issued at discount, how we issue them, forfeit them and reissue them, and then we will be taking a practical question on that, and then we will be discussing how we issue share at premium and the same points for that also, that is issue, forfeiture and reissue, and then we will conclude the important points in the above two cases, and after that we will be discussing the concept of calls in arrear, calls in advance and some miscellaneous topics like share issued to promoter, etc. So, let us start with the first topic today, shares issued at discount. What are the entries? Their issue, forfeiture and reissue, etc. While issuing share at discount, we debit share allotment account, discount on issue is also debited to equity share capital, and when we get the money, the entry will be bank account debit to share allotment. When these share issued at discount are forfeited, then the entry will be equity share capital account debit and discount on issue will be credited back, because when we issued the shares it was debited, when we take it back it will be credited. To shares forfeited, whatever we have received, and to various calls like allotment and first call, whatever is unpaid. So, you have to remember that discount is credited back on forfeiture, and please remember when we will reissue it will be again be debited. Let us see the entry. When these shares are reissued, the entry will be bank account debit, discount on issue debit, and if still some discount is there, it will be debited to share forfeited account to share capital. The important point is whatever discount was credited, it is again debited, and if we still need more discount, it will be debited to share forfeited account, right. So, to conclude we can say first debit the discount on issue, then credit on forfeiture and then debit again on reissue. Let us see this question. Dipanshu Limited issued 10,000 shares of rupees 10 each at a discount of 10%, payable 3 on application, 4 on allotment and 2 on first and final call. So, 1 rupee discount will be adjusted on allotment if nothing is told. All the money received except final call on 500 shares. So, these were forfeited and subsequently reissued at 6 rupees as fully paid. So, we have to show all the journal entries, right. Let us start the question. The first entry will be bank account debit 30,000, that is 10,000 into 3, to equity share application 30,000, being share application money received. Please note we have to give narrations with every entry. Second point, equity share application will be now transferred to equity share capital and the entry will be equity share application debit 30,000 to equity share capital. The next entry, equity share allotment debit 40,000, that is 4 rupees, and 1 rupee discount will be debited here, discount on issue debited 10,000 to equity share capital 50,000. And when we receive this money, bank account debit 40,000 to equity share allotment 40,000. Next, first call due, equity share first call account debit 20,000 to equity share capital 20,000, and now we will receive some money less on the bank entry, and that will be like this. Bank account debit to equity share first call 19,000, that is 20,000 total due minus 500 into 2, whatever amount is not received. In the next entry, when we will forfeit these 500 shares, the entry will be equity share capital account debit 5,000, that is 500 shares into 10 rupees the called up amount, and discount on issue will be credited. I have told you whenever we are forfeiting the shares, it will be credited. Discount on issue 500 into 1, 500 rupees, and to share forfeited 500 into 7, whatever you have received will be credited, and to share final call what you have not received 500 into 2, that is 1000 rupees. So please remember, discount credited on forfeiture and share forfeited credited with the amount received, and the final call whatever you have not received is again written with the name share final call 1000 rupees. In the next entry, when we reissue these shares at 6 rupees, the entry will be bank account debit 500 into 6, that is 3000, discount on issue debit 500 into 1, 500 rupees, and share forfeited debit 500 into 3, because you still need 3 rupees discount, as you have issued at 6 rupees, 1 rupee was discount, and the remaining 3 you will be using from share forfeited account, that is share forfeited debit 500 into 3, 1500 rupees, and to equity share capital 5000. Now out of total share forfeited 3500, you have used what amount? 1500, and the remaining will be your profit, and the entry will be share forfeited account debit to capital reserve, that is 2000 rupees. So our next case is when shares are issued at premium. The entry will be equity share allotment debit to equity share capital to security premium account, that is the entry number 3 on allotment, and when we receive the money, bank account debit to equity share allotment. And when these share issued at premium are forfeited, we do this entry equity share capital debit, called up amount, and security premium will be debited if it is not received. I think you remember I told you in an earlier class that security premium gets debited if it is not received, and if it is received, it's your income, then it will never be debited. So let's do this entry equity share capital debit with the called up amount, security premium debit if not received, and again to share forfeited whatever you have received, and to equity share allotment and to equity share first call whatever you have not received will be coming with their names. And when we reissue this, bank account debit, share forfeited debit to equity share capital. If at all we are using share forfeited, then it will be debited, and of course we are issuing at par or at premium, then we will not use this share forfeited, and it will be simply transferred to capital reserve account. So let's conclude the important points of the above two discussions. First point, forfeit whatever you have received. Second point, premium will be debited only when it is not received. Next, discount will always be credited on forfeiture. Next, if required, discount again debited on reissue. And the last point, amount not received is credited on forfeiture. Whatever amount is not received is credited on forfeiture. Let us discuss the concept of calls in arrear, calls in advance, etc. Calls in arrear means whatever money is not received from the shareholders. When you make a call and they don't pay the money, that is called calls in arrear. We have to take interest at 5% per annum on those calls in arrear. Please remember, calls in arrear interest rate 5% per annum. Now, directors can waive this interest, means they may take, they may not take, in the best interest of the company and shareholders, right. So, they have an option. And the next concept is calls in advance, that is when somebody pays money in excess of what is required by him, that is money received in advance from a shareholder. The interest will be given to him at the rate of 6% per annum. Please remember, calls in advance we pay to shareholders 6% per annum, and this charge has to be paid, means this is not at the discretion of the company, you have to pay it. So, how do you remember 5% and 6%? You can remember like this, company is a big person, so they pay more and take less. Company pay 6% per annum to you and take 5% from you. Okay. Now let's discuss another point, when shares are issued to promoters or underwriters. But for this you must understand what is a promoter. Promoter is a person who conceives the idea of bringing the company into existence. That is, he do the simple homework, what should be the name of company, what the company will be doing and all that things, right. And who is an underwriter? He guarantee that if you take money from public and if public is not interested in that, he will take that particular amount of capital and provide the company with the money required, right. So, he is guaranteeing the raising of capital. If public is not paying, I will pay it. So, you better go with your project and do not worry about the money part. So, please remember, promoter means who bring the company into existence and underwriter means who guarantee the money part, right, money part. When we issue the shares to promoters, these are considered as formation expenses, that is goodwill. So, you can name formation expenses or goodwill, whatever you like, both are okay. So, the entry we make is formation expenses or goodwill account debit to equity share capital. Now, this is for promoters, right, but when we issue it to the underwriters, so let us think about, if we are paying underwriting commission to the underwriters, what will be the entry? Underwriting commission is an expense, it will be debited, and to underwriters they will be credited because we have to pay the money to them. And when we have to take money from them, then underwriter will be debtor for us. So, underwriter will be debited and equity share capital will be credited. So, when we are paying commission, they are our liability, and when we are issuing share, they are our asset. So, we have to take money, right, and then we will make a net entry, whatever we have to give or whatever we have to take. Suppose we have to take money from underwriters, then it will be bank account debit to underwriters, or if we have to pay money to them, then underwriter account debit to bank, that is receiver, credit what goes out. Okay. Let us start with some miscellaneous concepts like under subscription of share. When the company invite application for shares and the application received are less, in that case we will issue only those number of shares which are actually applied by the public and not the issued capital. So, effect is that our paid up capital will be less than the issued capital, because if public has applied for less, how can you give more to them? They have not applied for it. Okay. Over share means when public applies for more share than demanded by the company. So, it is a case of oversubscription, but the company can choose any of the following options. First, either they can refund the excess money and allot to the remaining, or they can allot pro rata to all applicants, or there can be a combination of both the cases. But please remember, company cannot issue more share than what is actually offered to the public. Maximum capital they can give is whatever they have offered to the public. Let us talk about what is sweat equity shares. Section 79A of Company Act says, if we are issuing equity shares to employee or directors at a discount or for consideration other than cash, because they are providing technical knowledge or their intellectual property rights to us, right, they are doing something for the company. So, you are issuing to them the shares at discount, that is called sweat equity share. Now, what is right shares? Right share are those share when company offers share to those people who are existing shareholder, they may take whole or they may renounce some of them. Renounce means they may say we are not going to take it. Only after that a company can issue the shares to general public when they have decided whether they are going to take or not take. If they are not taking, only then general public can be given those shares. Let us talk about a concept, buyback of shares. Section 77A. when a company purchases its own shares itself, that is called buyback of shares. It can be done through a fresh issue of shares or other specified securities, or it can be done out of free reserves like general reserve and P&L account, or it can be done out of security premium account. So in today's discussion, what we have done is, I have told you about some issue of shares at discount, at premium, their entries on issue, reissue, forfeiture, and what are their important conclusions. And then we have talked about some miscellaneous topics like buyback, etc. So in the next class, we will be starting with a new chapter, and that will be issue of debentures. Right? Till then, thank you very much.